Resurgent India Knowledge Series present. Virtual session on unlocking opportunities, alternative investments in the financial services sector. Mr. Ashish Agarwal, Director, Resurgent India Limited. Chartered Accountant and Management Graduate Ashish Agarwal has a rich experience of more than 25 years in financial sector. He has an extensive knowledge in credit and investment banking, corporate finance, capital market operations, foreign exchange services, debt syndication, wealth management and financial advisory services. Ms. Smriti Chandra, Investment Director, Able & Nordic. Smriti Chandra is an investment director with Able & Nordic, a public-private partnership fund focused on investing into financial inclusion in developing economies. She leads their investments in India, supporting early-stage, low-income, rural and women-focused financial services businesses in increasing their outreach and strengthening governance. She has also worked in the transaction advisory services practice for a decade. Smriti is an investment professional with 20+ years of experience in the impact investment and investment banking industry. Mr. Amit Goyal, Executive Director, Carpe Diem Capital. Amit has 20+ years of experience across private equity, corporate finance, and entrepreneurship. He has been involved in equity transactions aggregating over $350 million in India, South Asia and Southeast Asia and across varied sectors like financial services, consumer businesses, healthcare, manufacturing, agribusiness, auto and EVs, etc. His experience spans across both early and growth stage opportunities. Mr. Arijit Sarkar, Director, Trifecta Capital. Arijit has 13 years of experience as an investor, repeat entrepreneur, senior business leader, strategy consultant, and quant specialist. Previously a founder of a fintech startup, Tavaga, India's first goal-based passive investment platform. Arijit brings a diverse set of experiences to the firm and its portfolio companies, having worked across multiple domains in financial services, healthcare and retail. Mr. Abhishek Addy, Director, Amicus Capital. Abhishek is a member of the investment team in Amicus Capital, an India-focused private equity firm that invests in high-growth middle-market companies. In Amicus Capital, he leads investments in financial services and healthcare sectors. Abhishek has over 16 years of experience, of which 12 years have been in private equity and buy-side advisory. Abhishek is a chartered accountant and a postgraduate in management from the Indian Institute of Management, Ahmedabad. Mr. Gaurav Sekhri, Partner, TV's Capital Funds. Gaurav Sekhri has 18 years of experience in VC, PE investments, public markets, and banking. Gaurav Sekhri is a partner at TV's Capital Funds. He leads investments with end-to-end responsibility for executing transactions. He is also an active fundraiser. Gaurav worked as a principal for private equity investments with the Piramal Group prior to joining the TV's Capital team. His investment experience is spread across sectors including healthcare, consumer, retail, and financial services.
Yeah, friends, good evening to all. I am Ashish Agarwal. I am from Resurgent India Limited. I am one of the director in the company. As Resurgent India, we are running this knowledge series in the last 2.5 to 3 years, and it's a great success and got a lot of support from our speakers, panel speakers at every time, and they're coming and discussing on the relevant topics and the future of the industry. So I would like to welcome to all of you in this webinar, and this topic of this today's webinar is very, very important and very much relevant in the current scenario. You see this topic called unlocking opportunities and alternative investments in the financial services sector. as we have seen that this financial services sector is growing very, very fast actually, and we have lot of demand, and you have seen the many success stories in the past also. And many banks, many NBFCs, and the payment companies, or the insurtech or insurance companies, or the you see that the wealth tech, wealth companies also, everybody is now growing, and we have seen that the capital market also, which is supporting a lot also, and the growth of the NBFCs also. The digital lending is one of the area which is, I think, helping to this growth. Actually, digital or technology is helping a lot actually. So I know that we are talking. So majorly the alternative investment, what we called is this venture capital or private equity capital, or maybe venture debt actually, which is the area. Then we have public market. So public market is known to everybody that there are many listed companies are there, and so you see that the alternative investment, we are talking about the private equity and venture capital investments in this sector. And if you see the growth of this deals and investment last 7-8 years, this was a phenomenal growth actually, and lot of exits were also there from the investors' point of view. And last year, if we see 2022, there was the contribution of the total investments in the PEV segment, the financial sector, therefore it was something around 18%. So almost 1/5 of the investment is coming in the overall investment in this PEVC investment in the financial sector. This is because of that lot of untapped credit demand is there, and untapped credit population is there, which is not having credit access actually. So I'll say unserved and underserved people are there. Those are not, but because of digital lending, these people are not in a position to access of this credit. While sitting at your home or at your business or at your shop, they can get the money. Not only the private sector companies, the government and banks are also contributing a lot. Actually, if you have seen very recently, the government has come out with many schemes also. Savanidhi or many schemes are there which are at the bottom of the pyramid, so that these people will be having the credit access, and they'll be part of financial inclusion. And ultimately, these will be the customers for the NBFCs and banks also, and the payment companies and others also. And we are seeing that we have a lot of young population in our country, actually the largest young population in the world. So this is also helping us to get this sector grow, like increasing consumption by the growing middle class actually, or young people actually. So we are now moving towards, to some extent, on the consumption-led economy rather than the saving-based economy, although we have a good saving rate also. And people are now open for credit actually. Earlier, if you see that many people were not very keen to take the credit, so now people are open for that also. So this is again because they have access of the data and everything. And other than that, if you see this lending to the new lending products are also there in the market actually, where the people are focusing, like personal loans or consumer durables loans, buy now pay later actually, EV loans, 2-wheeler, 3-wheeler loans, and the MSME loans actually. This is again helping this sector also to grow further. And we see reach actually. So I think I believe that there will not be any place in India which is not covered by the institutions. So if you see the payment point of view, the Paytm and other companies, they have access or they have reached to each and every corner of the country. Like credit also through digital lending, I think now access is there. Only the question is that when these people will be a part of the ecosystem actually. If I see the investments by PEVC in last 1 year or 1.5 years, there are more than 10 investments which were more than $50 million investments. So it includes the M&A also, or maybe the private equity venture capital investment actually. So companies like Hero FinCorp and the Subham Housing, Kokta, Hinduja, Buddhati. So many Finova and all these companies have raised money in the lending space from the private equity investments. If I see from IPO point of view, the company like SBFC Finance, Utkarsh, SFB, Fusion Microfinance, 5 Star, all these have raised money from the public market also. It's a great success also. and these companies are doing very, very well. So friends, we will discuss on the opportunities for the companies in the financial sectors, for the investors also, and how do we see this growth in next 5-7 years in this sector actually, which are the new emerging trends or the emerging areas where the investors are focusing. We have very good panel actually from the investors who are having the different thesis or different thought process also whenever they are investing actually. So we have Smriti, who is from the impact investment or financial inclusion, which is the focus area, but we understand. Then we have Mr. Goyal, Amit Goyal, and then we have Mr. Abhishek Reddy and Nihar, were from basically from the growth investment in the mid category financial sector companies. And then we have Mr. Gaurav Sikri. Gaurav is from basically the area where they are investing in the larger size ticket or larger investments in the different financial sector companies actually. So it's a good panel where I can see we have covered, I think, the all kind of segments from the financial sector point of view. And all of our panelists have investments in the various financial services company. They will speak about their whatever the learnings or whatever their mandate of investment in this sector. And then we have some question answers which we'll take up. And I believe the audience will get more and more knowledge about the future of this financial services sector. How do we see actually? I was the part of this GFF Global Fintech Summit last week in Mumbai. Actually, it was a great success. Actually, you see who actually were there, and the solutions or innovations, the companies where they have participated. It was really great actually. So I think and this our this governor or the RBI governor has announced that this industry will be of $100 billion by 2030. This fintech companies actually, whatever the revenue which they are hoping actually. So there are a lot of growth is possible, and there are a lot of opportunities are also there. Now I would like to invite our panel so that they can give their perspective from the sector point of view. So as I told you that we have 6 panel speakers and all are veteran in the industry. So I think ladies first. So I'll invite Ms. Smriti Chandra to speak on about her journey or the whatever the fund called Nordic, the Abler Nordic. What is this fund actually, and how you are supporting the sector actually, and what are the learnings which you had in the past in the investment in the financial sector. Then I have some questions from her also, which if you can cover up, then it will be great also from your perspective. So can you elaborate on the trends in equity investment in the NBFC sector and
Sure.
both before and after the COVID-19 pandemic actually? But COVID-19 was really the situation where everybody has suffered, and how has MFI survived the pandemic, and how accelerating the further growth actually, because MFI got a major hit in this COVID actually. And then another question which we have in our mind, that increasing share of education loans in the NBFC sector. So education is again one sector where the lot of demand is there, has led to the emergence of specialized NBFC focusing solely on the education financing. How does a specialized product financing give a competitive edge to NBFC over its peers actually? So these 2 questions are from my side, but you are free to cover whatever you want to cover from the sector point of view. So over to you, Smriti, and thank you very much for joining us.
Thank you, Ashish, for having me over on the panel. And it's a privilege to be part of this esteemed panel. Just to begin with a brief introduction, I represent a fund called Abler Nordic. We are a public-private partnership fund from Norway. We started off in 2008 and with the prime focus to invest into microfinance as a sector. And now over the years, we have roughly $350 million asset under management spread across 4 funds. We focus on 3 broad geographies, South Asia, which is largely India, Sub-Saharan Africa, and Southeast Asia. And roughly 1/3 of our funds is invested in India today. And I manage the India portfolio and India team. In India, we have roughly about 9 investments live as we speak, which spans across microfinance institutions, business correspondent institutions, affordable housing, small finance banks, and around. Historically, as I mentioned, we started off as a microfinance investor, and for the first 7 to 8 years of our life, we remain in the sector of microfinance. Over the last few years, we have started to diversify ourselves as well, to look at different aspects of financial inclusion. Microfinance continues to be the bread and butter or the bottom of the pyramid that we address, but we're also increasingly looking at what are the additional financial services and products that the customer segment requires, and how can we enable that. As Ashish mentioned, we are an impact-focused fund. So while financial returns should be sustainable, the organization should be able to run sustainable operations with profits. But at the same time, we also focus a lot on the social aspects of the investment. And that could cover how responsibly someone is lending, that could cover outreach, that could cover additional products that we provide to our customers to build financial resilience in the households, and so on and so forth. So we have a very strict impact measurement mechanism as well, which we implement. Typically, we invest in Series A or B. So we come in relatively early in financial institutions, and stay invested for a period of 7 to 9 years in each investment. So patient capital. We actively participate with the companies, either as part of the board or with the help of our technical assistance facility that we provide to our companies as well, in a lot of areas, which includes technology improvements, capacity building, credit assessment engines, and so on and so forth. So that comes as a value add when we come in as an investor. So that's a brief introduction about Abler Nordic. Moving on to how we see the sector before COVID and after COVID, and what we are seeing now. I think when we were investing prior to COVID, of course, a lot of our companies, primarily in the microfinance space, were really doing well. Coming out of demonetization, they were establishing significant growth rates, expanding, so on and so forth. And once COVID hit, of course, it was a standstill period where we kind of said, stop all expansion, consolidate position, see what we can conserve, and then let's reassess. Post that, I think what we have seen is companies which were fairly well capitalized when we hit COVID, or were able to raise reasonable amount of capital during COVID period, have been able to sustain. And post the COVID period, they've established strong growth. In the last 18 months, most of our portfolio companies in the MFI space have established 30-40% kind of growth rates, if not more. And what also helped from an industry perspective is the change in the regulations, or the release of some of the constraints that we had for the sector. That kind of bumped up both the interest rates that we could charge, as well as the kind of customers we can onboard. And that has really started to show in terms of the business model. The profitability and the returns have started to come back for the sector. And what that also means is that we've seen a lot of interest coming back to the sector. We've always seen in microfinance that they go on cycles, right? So we see a couple of good years of investments, and then something happens, the most vulnerable class, we get impacted. But we've been so resilient, we come back, and then we again see a slew of investments. So over the last 6 to 8 months, we're seeing a lot of traction coming back. Most of our portfolio companies are either have done fundraise or are in the process, and we are seeing good interest coming from private equity. We're also seeing a lot of consolidation starting to happen in the space, which is again good. And as Ashish mentioned, we've also seen some IPOs that have done very well. So overall, I think right now the sector is in a good space, and it should run for another year or so. Then we will have to see what else will come and hit us at that point in time. But right now it's in the good area. But if I move away from microfinance and look at other forms of lending, I think everybody did get impacted during COVID in some form or the other, and nobody could steer away from it. At the same time, the asset class which came back pretty quickly was the housing space. We started to see a lot more traction. We started to see a lot more um, uh, interest in the affordable housing space that we tracked. The next to come back was the secured MSME lending space that also started to see a lot of interest. And now slowly we are starting to see unsecured MSME lending space also kind of grow and start to get their interest. Most of the cases, the credit losses have been taken on account. It's been recognized. So now we know what we're really dealing with as a loss, and companies are moving ahead. At the same time, I would also say that we've seen some companies where without having enough capital or for the want of capital have stagnated or have had to close down. So those stories are also there as part of the mix. I wouldn't keep that away. But wherever we had good capital, I think companies have been able to sustain, and now most of them are in the growth path. And what we see going forward is so far fintechs and different kinds of models that you were seeing were looked at as competition to NBFCs, but increasingly as we chart out the ecosystem and start to look at different aspects of it, it's becoming more and more clear that fintechs are more in enablers, and ultimately, even including the regulations, being overhang on all these institutions, there has to be partnership between NBFCs and fintechs in some format or the other, or partnerships between the banks and the fintechs in some format or the other, and they will typically be an ecosystem enabler. And the next set of investments, at least from our side, would be to look at some of these fintechs which are working with NBFCs in either outreach or improving processes, et cetera, et cetera. So that's definitely a segment that I think will evolve much faster as we go along, and that will be a focus area for us too. And lastly, specifically on the education financing, which Ashish mentioned, I think when we were in 2018-19, we were very actively looking at education financing as a sector and a space. And we did have good interest. We did have companies that are growing well, carving out a niche in this space. But come COVID, got impacted the hardest and came back or are coming back still at the last. We've seen companies shut down in that space. We've seen companies getting bought, sold. But as a category, I think for a country like India, where education is prime and there is cost involved, it's not either subsidized or provided for by the government, and it's aspirational. This is a segment which is here to stay. It will go through its cycles. And I guess the question is when you ride on that cycle as an investor will be important. We're seeing that some of the companies are coming back in the space. We are discussing as well as to what kind of investments can be done. But I see that if there are no further shocks, hopefully in the next 3-4 years, this is another area where we will see traction.
Okay, thank you, Smriti. You have very well covered your questions. So one thing which is good for the MFI, the change in regulation, positive change in the regulation. So it is helping to the sector actually. And education sector, you are saying that there will be ups and downs, but sector will remain in the system actually, and the demand will be there always actually. So you might not be looking to invest in such kind of companies as of today. Maybe later on you may make up your mind actually. But one very good thing which you have told that you are looking in future to invest in the fintech which are supporting to NBFC actually. This is a big change in the fund point of the Nordic point of view, because you are a impact fund actually, and then may look for the fintech investment. So it will be a great change also. And I think many fintech companies are part of this discussion where they are they have joined us from the different channels. They will be happy to approach you later actually on the requirement. So thank you very much for your deliberation. I think it was very, very relevant also. Thank you, Smriti.
Thank you so much.
So now, friends, we have Mr. Amit Goyal. Abhijit is from Carpe Diem Capital. He is Executive Director in Carpe Diem Capital. He is veteran in the industry. So Amitji, first of all, welcome to you and thank you for joining with us. And Amitji, so we'd like to understand about Carpe Diem. What is this fund basically? What are you doing in this fund, and what is your learning from the investment which you have? I think you have also have investment in the MFI sector, the and lending space. And other than that, we will be happy to know from you that the two questions are there for you basically. How do you see the competitive landscape evolving for NBFC in the coming years? So as I think Smriti has given one good point, actually, this fintech will not be the competitor, I think they will be the enabler actually. So what is your view on that actually? That need to be understood, because this is a very, very good point, because RBI has also now allowed this 5% FLDG to the fintech companies. So whether they will be the leading the game, or the traditional NBFCs will be the part of this game, or there'll be collaboration, or there'll be the competition actually, which need to understood. Then what has been the success recipe for the firm that have consistently thrived in recent years, given the increasing competition in the NBFC space? How do private equity investor identify this opportunity that offer a competitive edge actually? So this is very important, that how you identify the opportunity, and how is the central bank imposition of restriction on acquiring controlling stake in banks influence the investment landscape in NBFC for private equity firms? Because the RBI is very strict on the controlling stake in banks, so the many investors are moving toward the NBFC side. Or also, can you provide insights into more at such regulatory imposition that have influenced PE investments actually? So these two questions are there. One is related to the competitive landscape, and the another is the regulation is helping for investment in NBFC. So over to you, Amitji, and thank you very much.
Thank you, Ashish and Resurgent India, for having me here, and good afternoon, good evening to everyone. Let me start with introducing Carpe Diem Capital. So Carpe Diem Capital is a mid-market, growth-focused private equity fund. We currently have an AUM of about $120 million across multiple funds. And as a private equity growth stage investor, we focus on broadly two themes. First is consumer brands, and the second is business services. So our thesis is that people will move from unorganized sector to organized sector, and unbranded products to branded products. And hence these two themes that we focus on. Within these two themes, there are multiple sectors that we look at. So apart from financial services, we look at food, FMCG, retail. We look at agri and agri-processing. We also do healthcare, and we also look at any kind of business services, whether it is people management, process management, or facilities management. Playing on again the theme of move from unorganized to organized kind of a sector. We as a fund, we like first generation entrepreneurs, especially professional turn entrepreneurs, because we see that those guys have that fire in the belly, prove themselves. And we invest in entrepreneurs. We back those entrepreneurs which have majority of their network invested in their entrepreneur and in the company, so that there is maximum alignment of interest between the entrepreneurs and us. We take very concentrated bets, so we like to take 26% plus stakes in all the companies that we invest in. And our ticket size ranges between 50 crores to about 70-75 crores, that 60-70 crores being the sweet spot for us. And we are flexible on either side, both especially on the higher side of this range. We again, the size of the companies that we typically look at is between 50 crores to 250 crores. And as an investment approach, we are slightly, old school. we believe that companies and the business model should be proven. We prefer companies which are cash generating and which are EBITDA positive. So by default, which any business model which is not not generating cash on a sustainable basis, we avoid investing in them. Fund one, we invested into eight companies, and fund two, which out of which we are currently investing, we have made 3 investments. And the financial services side, we have a microfinance entity called Sindhuja Microcredit, based out of Noida. And I have personally, prior to Carpedium, also been involved in 2 other financial services firms, Equitas. So while I was at DG, the German investment firm, I did these 2 investments. One was Equitas, the other is Mass Financial Services. But, and Sindhuja is a company which we share with Smriti, which Abla Nordic, so they are also an investor there. And together we have seen, the company face multiple crises like LNFS crisis, then GST happened, and then also, 2.5 years of COVID, which deeply impacted the MFI sector. But very happy to share that, the company has really done well and they have come out of this crisis. And, some of this, I again want to link to one of the questions where you said, what do we look at when we are investing in these companies? See, MFI as a space, we thought, when banking licenses were issued, small finance banks, out of 10, 8 of them were microfinance entities. When they become SFBs, their focus changed. They wanted to gain CASA. They wanted to manage their liability, focus on liability management. And when that happened, see, the MFI client base is not someone who would keep their savings in current accounts or they would have savings account. So they had to shift their customer focus to, customers who have extra money, who have savings and, who can provide them CASA. And that is by default, by structure, left a lot of white space in the MFI segment. And so that was one of our thesis why we backed Sindhuja. We saw a lot of white space in that segment when the SFB licenses were issued. Second important thing that we note and we focus on is founder quality. And again, this is something that there are 2 founders here at Sindhuja. Both have over 15 years of experience in the MFI and the financial services segment. They worked together earlier, so they knew each other. And they were all working with other companies, and now they wanted to start their own MFI. And, back to our thesis of professional turned entrepreneurs, which, we prefer. And they're basically all or most of their net worth was invested in this company. So, these are the factors that are very important for us while making an investment decision. Thirdly, as an investor, we also are very, because we take significant stakes, we also prefer to deeply engage with the companies. We end up spending 5 to 7 days in a week, in a month, to help the companies fill in gaps in various operational aspects, whether it is product development, market development, or helping them raise capital, or setting up internal systems and processes. So, when we are scouting for investments, we also, look at it more as not just writing the check, but more as a partnership where we spend a lot of time with the founders to get to know them. And we also give this opportunity to the founders to let us so that they know us inside out. Because, the next 5 to 6 years where we are going to work in a partnership with deep engagement, deep involvement on a very regular basis. So, these are some of the factors that we look at while making the investments founder quality is very, very paramount. Integrity is of paramount importance for us while evaluating. Smriti talked about the competitiveness and the consolidation. I fully agree with her. There is what we are already seeing is large national players, prominent established players looking at acquiring the companies which are regional players. So basically, prominent players are looking at two kinds of growth. One is M&A, so they can grow inorganically quickly. The other is also a trend which we are witnessing is a lot of these finance prominent players, they're basically getting into adjacent products. So for example, Bajaj Finserv, they have now started doing MFI. They have started a LAP product for SME segment. They've also got into tractor financing, which traditionally they have never done. Right. Similarly, if you look at Piramal, so they have got into used car loan segment. So we are seeing these large players moving into adjacent segments to basically fill up their product gaps, and we see this consolidation continuing. Again, I agree. These fintech players will be more of enablers rather than end up competing with the larger NBFCs, because see, fintechs where they are focusing is more on the IT-driven sourcing of the leads and the customers, and then servicing of these customers. We also see a lot of AI, IT-driven product servicing. For example, HDFC's IFL. Even Muthoot Finance, their loan sourcing and processing is now all automated online. Even they use chatbots, WhatsApp-based chatbots to solve investor queries. And so, these are some of the trends going ahead, which I think overall help the sector mature. And regulation-wise, what we have seen in the MFI segment is, I think BFSI segment is very important. It's a backbone of the country. So we are very positive on regulations, and what we have seen recently, has basically provided a level playing field across all the players in MFI. And so we have a very positive view there. It will, in earlier, MFIs were looking at individual repayment capacities, but now they have to evaluate the credit worthiness at the household level. I think this is very important because the household level, you don't distinguish between individual income versus the other person's income. So to do the credit evaluation at household level is very, very important. These are my thoughts. Happy to address if you have any more further points.
Thank you, Abhijit. I think you have very well covered both the points also, and your fund journey also with the example. I think that's great. You've taken the example of your investing company and how you have supported them also, and how you have selected them. That is more important, actually. So thank you very much once again, friends. Now we have another experience of veteran another speaker, Mr. Arjit Sarkar. He is director in Trifecta Capital. So Trifecta Capital is into venture debt also, and they're into equity investments also. So first of all, Arjit, welcome to you, and thank you very much for joining with us. So we'd love to understand about your fund journey, and I think you can cover a little bit on the venture debt, because many people are not very clear what is this venture debt actually, and how the venture debt is supporting the financial services companies also, and the equity investment which you are doing or you are looking for. And other than that, we have two questions from you. So one is that could you provide insights into the strategies fintech lenders employ to mitigate risk associated with the unsecured loans? So as we have seen, a lot of unsecured loans are there in the lending space, in particular in the increasingly digital lending environment. And another is while fintechs continues to receive maximum PEBC investment. So if we see the data in the overall investments on the PEBC side, the maximum is going into fintech. But this trend has reversed in last 1 or 2 years actually. If you see that in the overall financial services, this it has reduced to 47% from 64%. So in 2021, in the overall financial services investment, the fintech was having 64% share, which is now 47%. So almost 17% share has been reduced actually in the overall investment. So what is the reason for the investor attention has shifted to funding traditional businesses like NBFC, HFCs, and MFI and banks? What is the primary driver behind that shift? So these two questions are from our side and your journey of your fund. So over to you, and thank you very much.
Thanks, Ashish, and thanks for having me on this panel. Hi everybody. Very quickly, I'll just introduce Trifecta Capital. So Trifecta Capital is in the 8th year of its journey now. We started back in 2015 when there were no other venture debt funds in India. I think there was some attempts to be doing this from NBFC construct, but a fund didn't exist in this space. Now, venture debt, again, taking a step back, venture debt itself is an asset class, which is lending to startups, lending to new economy businesses. Unlike what Mr. Amit, the previous speaker, touched upon, where they're looking at EBITDA positive businesses, more mature businesses. I think we look at much younger companies, startups which are not close to profitability, though they have a business model in place. So, on a very core unit economic basis, something is working. If we see signs of that, then we support initially with credit, but around 2 years ago, we also launched a growth equity fund. So we are also supporting with equity investments. Now, why should a startup take a loan? I think if there is a very predictable use case where there is a path to grow without diluting further equity capital, because a lot of these startups are raising equity on a continuous basis and diluting a lot of the founders' shareholdings. Debt is a way to manage that if used correctly and in a measured fashion. And we help and guide companies to utilize debt in their journey. So our own journey, over the last 8 years, we've supported around 150 odd businesses. So it's a large portfolio. I was just taking a look before this discussion. Out of those 150, around 20 odd companies would be in the financial services space. So from the number of companies, it's actually relatively small. A lot of investments, and this actually mirrors venture capital flows as well. A lot of the investments had gone into consumer internet, consumer services, and businesses. But when we look at the quantum of investment, actually, more than 30% of the capital has actually gone into financial services. So these are actually businesses which can absorb a lot of capital. And historically, both across private equity, venture capital, you will see a substantial portion, like Amitji mentioned, it's the backbone of the industry, of the Indian economy. And even if you look at the public markets, out of a 3 trillion, 3.5 trillion market cap, 1 trillion is in financial services. So it's a hugely important sector. In startups, it's a segment which can absorb a lot of capital, and you have relatively predictable business models, especially on the lending side. We typically, and lending startups also utilize a lot of debt in their journey because it's raw material and capital for their business. We have seen, in fact, lending, while it's an important segment, while going through our own portfolio, we have insurtech players, we have wealth tech players, and quite a few payments businesses as well. But lending itself is probably the largest revenue pool. And, in fact, even in consumer internet, consumer services, a lot of businesses are looking to add lending as a feature. So, it's not just fintech businesses which are looking to use financial services or, lending, but a variety of businesses are actually looking at either doing some lending activity themselves or serving as lead generation for other financial services players. So with that kind of broad context, just quickly, apart from venture debt on the equity side, we have also launched equity fund around 2 years ago. And from there, we've taken our first kind of measured bet in the financial services space with Auxilo, which does education lending, which again talks to previous discussion that we had. So we are seeing different kind of opportunities and revenue pools opening up across fintech. Payments has always been very, very active area in India. Just what we've done on the digital public infrastructure is just amazing. And you have you mentioned the GFF. I think around 40% of the companies there were doing some innovation in payments, right? Which is just fantastic. The pace of new ideas and development which is happening there. So now coming very quickly to the questions that you asked, I think unsecured lending, how do companies really mitigate their risks or manage their risks? So from our experience, we've done a few unsecured consumer lending businesses like Credit B, like Kisht, even Zest Money, and a few others. And what we've generally seen is, and all the panelists would be familiar, there are two ways to really look at risk in this space. One is what you do before handing out a loan, which is your credit processes. And what do you do once you've made the loan? How strong are your collections processes? And at least in the fintech space where we operate, obviously, there are much larger NBFCs which have cracked this at scale. But on the fintech side, the innovations that we see on credit are using different modes of information, not just your classic bank statement. There are lots of segments of the population which were either unbanked or new to credit, don't have a formal credit history. And it's very difficult to underwrite those without, alternate forms of data. So the fintech lenders are not just very efficient at origination and finding customers who don't have access to credit or haven't gone through the formal banking channels. But it's also very, very interesting, the models which companies come up with in terms of looking through maybe some of your social data, looking through different forms of your transactions, your SMSs, and obviously there are concerns around how do we manage that better, around privacy, around data protection. But within that overall space, I think there's a lot of innovation in terms of different alternate forms of data and using that to underwrite. Another form of risk mitigation people usually do is they will start with a smaller loan. So they will, begin with, maybe 45-day, 60-day kind of product, and scale a relationship as they build up their own credit history, right? For some of the BNPL guys, they will, because it's at a point of transaction, a loan has been made. You would also try and reference what is the other transactions that such a person has made on the platform. So you try and build a picture of the person that you're lending to, and definitely a lot of fintechs are innovating, coming up with different ideas there. On the collection side, probably the legacy players have a lot of experience and have done this at scale. But what we are seeing amongst some of the fintech lenders is they're learning from that and drawing from that, really. Most of them started out with outsourced kind of collection models where they would empanel agencies across the country, but they gradually realized that how you incentivize these agencies is important. What part or what are the characteristics of a loan or the repayment behavior where you should actually try and have your own collection agency. So segmenting the population and seeing where a default is happening, why is the default happening, what is the kind of behavior of the customer before a default happens. can help you understand, what is the most efficient way to collect, because collections is very expensive, and it's a large part of the operations cost for any lender. So, so again, I think both on credit and collections, even when we underwrite a business, we go deep into what are the processes which have already been built in, and more importantly, what is the learning process and the kind of continuous improvement which these companies are doing, because nobody has it perfect on day one, especially young companies where we come in. But we look to see as to how processes have matured over time. So yeah, that's
okay. Thank you, Arjit. I think you very well covered both the points and your fun journey also. And rightly said, these fintechs are lending, but they are having the better underwriting thought process by way of smaller loans and the other way of social data screening. So these things are helping, which was not there earlier in the thesis of the NBFCs actually, which has come now. And the collections also. So collection is still a big challenge actually for this kind of segment. Still, they not figure out at how these small collections are across while sitting in one office and you are lending to entire country. So this is again a question actually, but definitely there will be some solution later on. So thank you, Arjit, for your nice deliberation. So friends, now we have Mr. Nihar Thanawala, who is the Managing Director of Motilal Oswal Alternatives. So first of all, Niharji, welcome to you and thank you very much for joining with us. So we'd like to understand, like Motilal is a known name actually, no need of introducing your company, but you definitely would like to understand what are you doing on the alternative side actually. That is most important because capital market point of view is a well-known name. And we would like to have some questions from you also. So the first question is, which is basically in the contest of the LP money to the AIFs actually, because unless until the LP will not have the money, then how they will invest in the company. So we'd like to understand in your experience, what are the critical considerations that LP looks when embarking on the investments in AIFs? What are the measures taken by fund managers to provide them comfort to increase their portfolio allocation in AIFs actually, because this is a new asset class. So many times the HNI, Ultra NHI, family offices are having some kind of reservation to allocate larger fund. So how you convince them? That's one thing, which is your odd question, not related to this, but it is again part of financial services actually, because AIF is also part of financial services. Then we have another question from you, because you are helping the real estate sector also. So you being a veteran in the real estate sector, how do you see the housing finance sectors shaping up, considering housing demand in the current scenario? So housing finance, what is the future of housing finance and what will be the new models which will come also? So over to you, Nihar.
Thank you, Ashish, and good evening to everyone. And Ashish, thank you for the entire team for having me here. So I think, like you rightly said, as a group, Motilal Oswal probably does not need an introduction. But having said that, let me just give you a quick perspective on what are the businesses that we are in, right? So we started as a group 36 years back by two gentlemen, Motilal Oswal and Ramdev Agarwal, as a broking business. And that today remains a flagship business of the group. But over a period of time, like most other diversified financial services companies, we've put our hands and legs into all kinds of businesses which are linked to the public markets and now also the private investment side. So we have our own mutual funds, we have our PMSs, we have our broking, of course, we have wealth, we have investment banking, we have research, a very strong research desk on the public market side. Outside of that, we have an alternate arm, which I'm a part of, where we do private equity and real estate both. Within private equity, we do consumer, healthcare, financial services, and industrial. And real estate is separate again, right? So that the other two focuses within alternates. And we have a housing finance company where the core focus is absolute affordable home loans. So that's the core focus. And when I say absolute affordable, is basically 10, 15, 20 lakh homes. So it's largely not even in tier 1 cities. So that's the housing finance company. So these are the various businesses that we are into. The alternates business is about 16 to 17 years old. And within that, real estate is about 12, 13 years old, right? And I'm a part of the real estate business. So as a alternates platform, we right now have till date across all strategies raised 9 funds, and we are actually in the process of raising our 10th fund as we speak. So I think, as a journey, it's been quite a journey for the platform. I've been here for 6 years roughly. And obviously the last 6 to 8 years have been fairly formative years in terms of all over differently. The first few years really helped us achieve scale in the last 6 to 8 years, when really the markets presented opportunities, in a big way. So I think, that's a brief about the platform and the group. Cumulatively, across both PE and RE strategies in alternates, we have till now managed about 2.2 to 2.3 billion US. This includes money that we would have returned and money that we currently manage and investments that we are there in right now. So as a focus in real estate, so our approach has been, mirrored. Our approach has mirrored how the sector is, right? So 80% of all real estate is actually residential. In the same way, from an investment strategy perspective, 80% of our focus is also residential. 20% forms all other asset classes, but of that, office is the largest. So we put about 20% in other asset classes, but we focus only on office and to some extent retail. We don't invest in any other asset classes, at least as of now. So we don't do data centers. We are evaluating industrial, but we haven't done anything so far. Right? And within residential, our approach is, so we are a financial partner. We don't build homes. We partner with developers in the key cities in India, so most tier 1 cities in India. And we provide capital to them at different stages of a project. Our core focus though, because from a return perspective, we target, high teens. So our investment strategy as a result also is to come in a little early at the project stage, where capital is required for growth. And then after the project matures, we lever the project using cheaper capital from banks to kind of up the return. So that's broadly our investment strategy. As a platform, as a real estate platform, in the last 10, 12 years, we've done about 150 investments and we've got 75 exits. So by the numbers itself, I think, we've actually had more experience doing projects than most developers, if you look at it from that perspective. And this has been spread across, different cities. So I think that's broadly what we do, right? Coming to so I'll address the housing question, which is your second question first, right? Because we're on that track. So, let me give you a few statistics which will help you understand where we are from a housing perspective, right? Last year in India, where we believe that last 1 or 2 years have actually been one of the peak years, right? When you look at the last entire decade. But last year in India, we sold as a country about 3.2 to 3 lakh homes. Okay. In 2011, we sold 4.5 lakh homes. Okay. And we're talking about last year being one of the best years in real estate, especially residential. If you eliminate investor demand, right? Because 2011 definitely had more investor demand. To the extent, let's say you eliminate 25 to 30% investor demand, we are still selling as many homes in the last year as much as we did from an end user perspective in 2011. If you look at where we are from a GDP perspective, from an affordability perspective, from a consumption level perspective, any of those metrics, we are at least 2 times higher than what we were in 2011. This is the latent demand that we are talking about, which is still not being addressed in the market, right? Now, there are various reasons for it, right? We all know that the last decade has been fairly disruptive when it came to real estate. And we had a series of events with demonetization, RERA, GST, the entire NBFC crisis that happened in 2018. So we know all of that. So there has been an impact, no doubt about it. But going forward, it will take 3 to 4 years to just reach 2011 levels. So, and the consumption by itself has gone up, right? COVID has obviously been a huge catalyst because the importance of buying a home has gone up so high that earlier when people used to do a mathematical comparison, right? Even I used to do it. Everybody did it. That what's the rent versus ownership? What is the yield? It didn't make any sense. Today, nobody gives a damn. Today, the point is if you have your own home, you have your own security, and there is some sense of completeness. That topples any kind of mathematical equation. And we've done a lot of surveys and we've done a lot of feedback sessions with various sets of people, right? And the consistent feedback that comes is when it comes to your own home, no math works. The second trend that we are seeing is people who are in their 50s, they are now immediately, and they already have their own home, they are having the same approach for a second home, which is for their next generation, right? So these are two needs that are actually end user needs, which are driving most of the demand. Investor demand by itself is there, but it comes and goes based on interest rate cycles, right? They just spark the demand if people feel that, all right, if it's a 6-7% rate, with some kind of income tax benefit, there's that, it just makes sense to invest in a home. But the minute the interest rate cycle goes up, this kind of demand starts to narrow down. On the contrary, as far as the end user demand is concerned, in the last about 15 months, the interest rates have gone up by about 2.5%. Quarter on quarter, the housing sales have still kept going up, right? Which is quite counterintuitive because ideally if interest rates are going up so much, the demand should be falling at some point, at least not growing. But it has been growing in every city quarter on quarter. So at some level, people are understanding that any home loan you take is a 15-year loan. On an average, depending on the segment you're looking at, the home loans that are going for 15 to 20 years, the average maturity is somewhere between 5 to 10 years. In a 5 to 10 year cycle, regardless of where you enter in the interest rate, your cost actually gets more or less evened out. So that is not becoming a deterrent at all. Secondly, home loans are, and I have a lot of people on this panel, so they'll agree, they have been proven to be products with the lowest delinquency from a financial services point of view. So banks, NBFCs want to get into this category. And the second point is home loans are one of the best products to acquire customers over a life cycle. So banks are subsidizing or reducing the spreads to get more customers in through the home loan channel. Developers are also absorbing a part of the cost when the interest rate goes up. So all in all, right, the entire ecosystem is aligning itself to augur for a much larger growth that will come into the residential space, right? So in general, that trend that we are on, which is now volume-based, is here to stay. There will be bubbles, residential, real estate, all of it is cyclical to some extent. There will be bubbles where you will see something going up and collapsing. But all in all, I think it's a more of a steady state growth that we are seeing as compared to whatever the growth one may have seen in the last maybe even 20 years, right? Now coming to alternative investment funds and LPs outlook, right? Not just towards real estate, but in general, because we raise different funds. So see, AIFs is a very new product category, right? It's like not even 12 or 13 years old. Before that, we had PMSs, then temporarily SEBI came out with DVCF, and that DVCF has been modified into AIF. But all in all, it's still a very new product category, right? Most of the funds that have been raised have been raised through institutions, right? So in the past, when AIFs came, ICICI will have some fund, or Motilal will have some fund, or most of the people will have some funds. Eventually, all these products have been sold to investors as a product within the larger institution. So, and even SEBI is continuously fine-tuning, right, how the AIFs need to operate to better protect the interest of investors. So it's a very early stage, right, as a product category. And for any product to become successful, it has to go through at least one or two cycles, full cycles, where funds are raised, invested, divested, and closed. Now we have reached that stage where funds that were raised maybe about 10 years back have reached that point where they need to be fully closed, right? And of course, the performances are speaking on how well this category is doing. So this is actually the last 1 to 2 years, and the next 1 or 2 years is a report card, actually not just for the specific funds, but even this category as a whole, right? And people are assessing AIFs based on that perspective. Will AIFs attract a lot more capital as we move forward? Honestly, they have to, because alternates is a very integral part. If you look at any country, alternates has played a very strong role, right? And a significant one, complementing public markets and all other asset classes to grow as a country, right? Everything that we do outside of public markets is done through the AIF route now, right? Whether it is venture capital, whether it's private equity, whether it's real estate, whatever you call it. And the domestic capital is increasing, investable capital. So over a period of time, that maturity also is coming in with investors. People are understanding how it works. And even the other stakeholders like advisors, distributors are now aligning themselves well to why AIs are important and sending that message to the investors. So I feel that there is a lot more, like right now we're raising our 6th fund compared to the 4th fund that we raised about 4 years back. Today, nobody asks questions about what AIF is and how investors' interests are protected. Today, people want to know more about how we are managing certain things. 4 years back, a lot of people had questions on how AIFs work also. Today, nobody seems to ask those questions. So there is a process, right? And I think we are evolving in that process. So I believe in the next few years, AIFs will become popular. And people will want to put a large amount of capital, and they will not be looking at AIF as a category, but they'll be looking at what is the strategy that the AIF is doing and how much they want to bet on that strategy. So I think that's the logical step of evolution which we are on.
Thank you, Mr. Nehar. Thank you very much. Very well covered. A lot of insights about the housing demand. I think some data point which we have given, which are eye-opener for all of us actually. And such a veteran professional in the real estate sector, I think, can give this kind of insight actually. So it will be helpful to the entire industry, the housing finance companies, who are participating here also as audience. Thank you once again. Friends, now we have Abhishek ji, welcome to you, and thank you very much for joining with us. So we'd like to understand about your fund. What are what are the investments you have done in the financial sector? And I'll take one question from you because you've got the time constraint actually. So instead of 2. So the question which you'd like to understand from you, which is more relevant from the exit point of view, because for the AIFs, investment is important and exit is also important. I think exit is more important actually. So we like to understand what are the feasible exit options for the AIFs, the sector across NBFC, HFCs or MFIs, the lending sector actually. Which option is preferred by the investor and why? And can you provide examples of successful consolidation in the NBFC lending space through M&A activities? So mainly the exit option by way of maybe the different modes and the consolidation also. So over to you, and thank you very much, Abhishek.
Sure. So thanks, Ashish and the Resurgent team for having me over. So it's a pleasure. Good evening, everyone. So I'm part of Amicus Capital. So we are a relatively young fund. We started in 2016 when we raised our first fund, which was close to about $90 million. We are currently investing out of our second fund, which is close to $200 million. What we do is that we focus on companies which are early growth, wherein the revenue model is proven, and what we are essentially betting on is the scalability risk. The mandate of the fund is to invest across 5 sectors, financial services being one of them, the others being consumer, healthcare, technology and business services, and specialty manufacturing. Here we invest anywhere between 10 to 20 million US dollars as a ticket size, 12 to 15 million being the sweet spot. When we invest in companies, apart from a proven revenue model, there are a couple of other aspects that we look for. First of all is a strong management team. And the second is the potential to become a leader in the segment or the subsegment that they operate in. Because what we believe is that it provides the company the moat or the differentiating factor and facilitates an orderly exit for an investor, especially a financial investor, where exit is a very important aspect of the entire deal life cycle. Across this 12 funds, we have made, across these 2 funds, we have made 12 investments, and FS being a core focus area for us, we have made 4 investments in the financial services space. We have an investment in a small finance bank called Capital Small Finance Bank, which is based out of Punjab. We have an investment in a two-wheeler focused NBFC called Berar Finance, based out of Nagpur, and investment in an affordable housing finance company called Altum Credit, and then a tech-enabled insurance aggregator, which is basically a tech, it's an insurance distributor, which is Renewbuy. So those are the 4 investments that we have in this space. The underlying thesis, especially when we are looking at evaluating investments in the financial services space, is companies or business models which enables access to credit and other financial products using technology as an important plank in the entire business model. So technology should act as an enabler. And this access to credit and this financial products is especially focused towards tier 2 cities and beyond. Because what we have seen is traditionally a lot of the traditional lenders as well as other financial services companies have faced challenges in accessing this market, because either they're geographically dispersed or the overall market share or the market potential of the market is low, because of which they have not been able to access them in a cost-effective manner. So what we want to look at companies is where they are either leveraging their technology or their expertise to solve these problems of or challenges of market access in a cost-effective manner. The other things that we look for in companies in the financial services space, and especially in the lending spaces, focus on asset quality and a strong liability side. And this is, in fact, we have in all our investing companies, we focus on that when we are evaluating them. We are quite active in terms of our contribution to our investing companies. We sit on the board, contribute to them in various aspects, whether it is strategic or operational, helping them out with capital allocation, strategic decisions, corporate governance, team building, risk mitigation, or digital or formulating a digital roadmap for them. Because what we believe is that, again, as Amit had mentioned, that we believe it's a partnership, and the objective is to ensure that, and we are kind of a partner in the journey of the investing companies for a certain specific period of time. And what we want to ensure is that we make the company a better and stronger company during that journey, so that eventually when we get off, they're well equipped to move forward and grow at a pace which is strong for them. Now, coming to the point of exit, as Ashish ji mentioned about how we are looking at, or what are the views on that. What we have seen, especially in the lending segment of financial services, the most feasible exit option has been either through a sale to a larger private equity investor or through an IPO. Exit through M&A, although there, but it has not been a very prevalent method, especially in the traditional financial services space. Now, the good part about financial services, and especially in NBFCs on the lending side, has been that unlike other segments, this asset comes back to the market for raising capital every 18 to 24 months. And because financing is a raw material for them. So what it does is that when a company is running a process for a fundraise, it also enables a financial investors multiple opportunities to who have invested at an early stage to exit these companies by selling to a larger private equity fund. And it's also actually beneficial to the company as well, because during the early stages, when they would have raised capital from multiple investors, as they mature, they are able to rationalize their capital structure, wherein all these early stage investors can look to exit by selling them to a larger financial investor as well. And also, once the companies have achieved scale, then the investors can look for an exit through an IPO, which is possibly the second option. In fact, in most of our companies, I think what we look for is that at the scale that we invest in the sale to a financial investor or larger financial investor is the most plausible option for us, exit option for us. As I mentioned, that we haven't seen too many M&A based exits in the lending space, and that could be potentially because of various reasons, including the regulatory requirements and the time taken for regulatory approvals, which probably makes the process a little bit cumbersome in terms of consolidation. And most of the M&As that we have seen is primarily either for acquiring licenses which are probably smaller assets that have been acquired, or especially in case of distress situations. So because if the company is performing well and scaling up with strong growth momentum, it will always have access to capital to fund its growth, and the market itself is large. So that's why consolidation itself in the FS space has been few and far between. Probably the only space where I have seen some notable M&A transaction or consolidation happening is in the microfinance space, where several banks have acquired other microfinance institutions, be it Kotak when it acquired Sonata, IndusInd when it acquired Bharat Financial Inclusion. So I think that's my take on the exit process, where I think IPOs and sell to a larger PE investor is a more prevalent or more popular method of exit. M&A probably few and far between.
Thank you, Abhishek. I think very well covered what your fund also and the exit opportunities also. So consolidations are happening. It's not like that. What we understand, only in the distress situation of the small company, even the larger company like Grow Finance and all. If you see, there are examples where the good running companies like Poonawalla is sold out. This thing also housing finance company. So it is happening. Consolidation is happening at different stages for the different regions actually. So it will remain like that only, I believe. Even in banks also, you are seeing the small banks are selling to larger banks and all. So that's good. Thank you very much. Friends, now we have very important panel speaker, Mr. Gaurav Sikri. Gaurav is the director, partner in TBS Capital. TBS is a well-known name again, and they have very good understanding and experience of investing and exiting from the financial services companies. So first of all, Gaurav ji, welcome to you. And thank you very much for joining with us. We'd like to understand more about the TBS alternatives, because TBS is known name in various segments actually. And then we have some questions for you. So the very important question again from the very important person also for this is the valuation multiples actually, because every person from the audience is looking basically how the investors are valuing the companies actually. So we would like to understand the light on the throw some light on the valuation multiple in the sector like MFI, HFC, NBFC, which are basically raising private equity. So how do you basically they give the multiples and discuss some factors which might impact this valuation multiple and assist investors in the reaching the right kind of multiple, and how the AI, this collection, somebody has touched upon the collection part. So how the AI is helping this collection process or better collections actually in the industry. If you have some experience from your investing company point of view, which you can throw the light also. So over to you, Mr. Gaurav, please go ahead.
Thank you, Ashi. Great to be amongst all of you. I think to introduce TBS Capital, we've been around for 17 plus years. We partnered with close to 40 entrepreneurs so far. Many are listed now, and I think our strategy is bimodal. We do venture growth through late growth. We are rupee capital fund by design, and I think we've been investing anywhere from 50 crore to 400, 500 crore per investment rate. This is agnostic of the stage, but whatever the category merits. 3 areas of focus for investments: the financial services, B2B, and technology. And some of the companies that we partnered with, the likes of Nika, MetPlus, India Energy Exchange, PhonePe, Fred Avenue, Go Digit General Insurance, Five Star Finance, Liberty Capital, so on and so forth. I think just to quickly get to the questions. First, on the valuation multiple, two parts. I would say one, very important to get it right, both for the investor as well as the portfolio partner. Why? For three reasons. One, from an investor perspective, anytime you overpay on an asset or a company, you start from the back of the line. So you're always paying catch up as far as return expectation is concerned. So should not do that. Number two, I think this is something I think pretty much everybody's experienced in the last 2 years. I think when you end up, you know, doing some investments, including your investment or whatever, at probably non-market multiples, and when you do a follow-on round with them, it's always hard. So there are only two ways it goes. Either one bites the bullet and adjusts the price, or you secondly miss out on opportunities for growth because the fundraise follow-on was delayed. I think this is at least something that we've experienced in the last 2 years. I think third, the idea on valuation should be to optimize and not to minimize, because you are partnering with an entrepreneur company. So they should, the principle should be fairness when you're looking at valuation multiples. So, and they should also feel that they are winning in this discussion. So I think these principles, I would say. Second, the three broad categories, which is NBFCs, again, various, very wide. Maybe I'm a bit generalistic there. So for me, many factors driving multiples, good and bad. But I think three, in my view, which are most important are, number one is asset quality. Particularly, it goes a long way in how your company is rated. That affects in a big way at what rate of interest that you are able to borrow from. That affects your margin and flows through your P&L balance sheet. So that's very important. Probably a good benchmark to follow there is about 2 or less for asset quality. Second, I would say growth. I think there is no life without growth. That is valued well by the investors over a long period. Especially looking at building multi-decadal businesses, how you're able to drive it consistently, how you're able to create defensibilities, create competitive advantages for yourself, going across geographies. I think one thing particularly to keep in mind is, I think what we've seen is not being a solo product company, but being multi-product, because I think single product in our experience generally tends to its last lane quickly beyond certain levels. So growth gets impacted, hence the valuation. I think the third important thing would be how you run your operations. Two particular things in terms of your branches, if you have a branch model, your fleet on street. Third would be how you manage collection. So I think always driving efficiencies there are very important. So I think at least well-weather benchmark numbers that we sort of appreciate, look at, would be something like, say for an MFI, 40%, for NBFC, 30%, for HFC, maybe 15% or less. From a valuation multiple perspective, again, it is, I would say, if I look at MFIs, I would look at, because it's more cyclical. We've been investors there, so we understand that part as well. About 2.5 times price to what we look at. If I have to look at an NBFC, again, variety of NBFC, somebody delivering good ROAs, good ROEs, leverage and control below 5, ROEs sitting 17-18%. You would look at something in the range of 2.75 to 3.5. If it's an HFC, good HFC, I think the point around the opportunity is affordable housing, which is clear. Opportunity is tier 2, tier 3. So I think we would look at something like 3.5 to 4. Currently, I think 4 is running, but slightly on the higher side. I think on the debt collection, massive opportunity, surface only scratched. I think banks probably spend 80,000 crore to 1 lakh crore on just the collection process in India. Digital collection maybe is a couple of thousand, if not less. So massive opportunities. There I see 4 areas. Some are, I would say, monetize, but essential to have. I think the automation part of the entire process is a given that everybody should do. So that is an opportunity for various companies. With RPA is not something new, but I think people should do it. I think the second opportunities, I think where I think e-commerce companies have done better, which is managing the entire communication. I think Arijit touched upon that when he spoke about it, which is how do you optimize this collection process rather than going the traditional way of having call centers, making phone calls, and treating each recovery equal while it's not. And this is especially relevant in the world of data right now, data and cloud, I would say. I think third is how do you manage your people, which is your entire collection force. I think that is more from an execution opportunity from a technology perspective. I think I would say this is second most difficult after the first one, the RPA. And I think the fourth one, which I feel is a big opportunity, is the entire thing of management of the entire legal piece around it. How do you do that? Because I think that part of addressal is very, very fragmented, hence a big opportunity. I think why I feel is possible, what is possible now versus what was possible earlier is because I think this is, like I said, this is a world of data, this is a world of cloud, this is a world of integration. So all those digital bricolages are something which are reality and possible now. I'll again take the example of e-commerce. They've done much, much better. So I think that opportunity is there for leveraging in the financial services space. There are various companies building all sort of networks, bringing people together, bringing vendors together, and so on and so forth. So I think people who can combine this, I think probably younger companies can do it better versus hopefully banks have their own way and legacy systems have problems. But I think this is a great opportunity for somebody to build a holistic business, which will be a great service and must have good adoption by larger institutions. Yeah, these are my quick thoughts on.
Thank you, Mr. Gaurav. Very well said, actually, and you are candid about the valuations, actually, which you have given some kind of indications, what kind of multiples are there in the different segments of the NBFC. So that's good, actually, and you rightly given the good perspective. So people who are listening you, they will correlate with that also. So many times we have seen that some people are having the unrealistic thought process also about the valuation. They are carried away with the fintech valuation. So we must have also got some opportunity where people must be linking with that the valuation with their portfolio and all these the NBFC space. So because they have seen the valuation in the fintech, which was rocket high in the different manner, actually. So that's why we have taken this question that we should understand from people like you what is the realistic valuation. Thank you very much for your deliberation. So friends, I think we have already crossed the time that I'll take one or two questions from the audience. So we have one question from one of the NBFC founder. He is asking that what is the right time and which is the right stage when they should go for the raising outside equity or maybe private equity from the investors. So is there any ideal size or ideal time or any benchmark which is there for the any advice from your side to the this founder when they should go for the raising outside equity from the investors? So you can take anybody can this question, actually, and we can discuss on that.
If I can come in here, sorry, Arijit, you want to go ahead?
Yeah, I just had a small comment here. Just from the variety of folks on this panel, it's quite clear, right, that there are many different kinds of investors. So, there's really not necessarily a right time. You will find investors willing to support at different points of time. I think it's just, if you are building a business, if the idea is clear in your head in terms of what you want to do, then it's like a process of matchmaking, right? Finding the right investor. It's more of an art than a science. So and it's we've also seen, at least in the startup space, that the best companies never stop raising. So it's not a one-time process that you are reaching out to investors. It's a kind of continuous process for most businesses. So yeah, I think having clarity of thought on what you want to do, that's probably the only marker I would request. But yeah, Smriti, please.
No, I think I was kind of alluding to that. It's not one straight answer as to when you can actually raise. But if you're an NBFC, I think one of the key triggers for you would be where you stand on leverage, right? And if the intent is to continuously grow and you see there is potential in the market for growth, and what is constraining you is capital. I mean, that's a straight away trigger. Unless you can arrange for capital yourself through whatever means you can, you should not dilute. But until that point and after, if growth is the intent, and if you have everything in place otherwise, and it's only the capital constraint, I guess that's really the time from an NBFC perspective, where cash in, cash out is actually the business. So I would say that will be a trigger for you.
Okay. Thank you so much. I think it's a good reply on that. So then another question is diversification. So many of the NBFCs are now basically looking for diversification. So they have one product, and then now they're entering. So MSME is entering HFC, MFI is entering to HFC space also. So the question from one of the MFI founder, he had wrote this question to us. Actually, he was asking that whether it is right to diversify from the one segment to another segment for any NBFC, or they should stick on the one segment. As an investor, how do you see it actually? Would you be interested if somebody diversifying from one product to another product, or maybe one company to another company in the same lending space, but maybe the different product actually? So how do you see that as an investor? Anybody would like to take this question?
Take that. I think do well with what you start with and diversify them. I would say probably generally, at least what we've seen is you pick something, do well 3-4 years, pick the next one after that. You should do it, but the only thing is time it after you decently done well.
Okay.
We can add to that. See, basically there is one, see, MFI is regulated. So, there is limited headway for any NBFC MFI to diversify to multiple products. There is a limit of 15, 20, 25%, depending upon your cash reserves, etc. But what we have seen, especially in the MFI sector, is definitely, whatever is the headroom available to you, you should have other products. But you should not go into products which are, totally unknown, where you don't have an experience. So it's better to stick to MFI if you don't have experience across other products. But go for diversification, hire the right people who have the experience in those, let's say, if you're going for lab, if you're going for housing finance in SME or whatever else, better to diversify. And the second angle that they should also look at is geographic diversification within the MFI segment, right? Because MFI especially is very politically sensitive, and we have seen that historically in some pockets of regions in India, where this political sensitivity comes into the play, and then that can make or break the NBFC MFI. So they should think in both product as well as geographic diversification.
Okay, great. Thank you very much. I think now we already crossed the time limit, so I like to try to wind up this session. Actually, one last question to everybody, to all of you. So currently, I think we are having 16-17% of the total banking exposure, the NBFC industry in the country. Actually, correct me if I'm wrong. Actually, so in my opinion, my understanding, it is 17% of the total bank lending, the NBFC lending in the country. Actually, so in next 6 to 7 years, by 2030. All of you have evaluated many NBFCs and you understand the sector well. What do you think? What can be the ratio? Which this ratio will be same, or will go down, or will go up? Because bank lending is also increasing actually. So what do we think? Just a guess from our side. If you can throw the light on that, maybe in one line, will be helpful.
Let me go first. I think it's a wild guess, but I think it will kind of remain similar to what it is, because ultimately I think what is going to happen is a lot of fintechs and which are acting as agents or front ending the customer acquisition, which banks possibly structurally have not been able to do. So they will be more the front end in customer acquisition, while banks will remain the capital providers, because they have access to the balance sheet and they are able to raise money at a much lower rate than what all these NBFCs would ever be able to do. So, so I think it will remain same, or it might probably go up a little bit, is what my guess would be.
Okay, thank you. Anybody else would like to take this question?
Yeah, I think I agree with Abhishek. It's not going to be drastically different. There will be a slight growth in the overall pie, but just the sheer size and the fact that Abhishek mentioned that fintechs are going to play a role where banks are going to more and more partner with them and have outreach, which today they didn't have. I think that's where the whole kind of scale will come for the banks as well. So I kind of agree with Abhishek on this. We're not going to see an extreme shift. Growth will be there, but yeah, not major change, I would think.
Okay. So as for both of you, I think the ratio will not change much because of that. The fintechs are enabling the banks also. But we can understand. Anybody would like to add this also? Because this is a good analysis, good discussion which we had actually. I think it will be helpful to all of us.
Yeah, while fintechs might be as part of this, probably the factors which will drive that are going to be more regulatory and process related in nature. You just saw the largest NBFC being folded into a bank. So you're seeing some very, very large NBFCs being created again in the public market. So I'm not talking about the small companies. So that might skew the balance a little bit. But again, if the regulator feels more comfortable, there might be a few more banking licenses also. So my sense is the enterprise segment will drive this ratio much more than fintechs.
Okay, got it. Okay. So great. I think thanks a lot to all of you for taking time and be a part of this session. And I hope that this was a fruitful or knowledgeable session for all of us and our audience who was part of this discussion. I think they must have some kind of more knowledge or understanding about the financial services opportunities in the financial services sector from the investment point of view. And I would like to thank you to all of you from my core of my heart, actually, that you have come and you have participated at the short notice in this program and make it successful and made it successful also. And I would like to thank you to all the participants also who have joined from the different part of the country to listen us, and they listen us patiently also. And I would like to thank you to the Resurgent India team, the iBanking team and the digital market DM team. They have done wonderful job. They could bring us together, and they have worked on the questions and the entire setting up the entire webinar. So I would like to thank you once again to all of you, and a special thanks to Ojaswa also, because she was the person behind the show actually. So he's a hidden hero actually, I would say. But he did the entire work behind the show actually. So thank you very much to Ojas and Rohan. Thank you all of you for joining with us. And thank you once again. Thank you very much.
Thank you.
Thank you very much. Thanks a lot.
Thank you.
Thank you.
See you.